Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open T-Mobile US, ticker TMUS, episode 102. Lana, this company went from scrappy underdog to the biggest wireless carrier in America in about a decade. That is one heck of a glow-up.
It really is, and there's a lot happening right now. New CEO, new strategy, a massive acquisition still being digested, and a stock that is trading about 26% below its 52-week high. So the question for investors is whether that pullback is a buying opportunity or a warning sign.
That is exactly what we are here to figure out. Let's get into it. So T-Mobile US, headquartered in Bellevue, Washington, is a subsidiary of Deutsche Telekom, which still holds a controlling stake. The company was founded in 1994 as VoiceStream Wireless, rebranded to T-Mobile in 2001, and went public in April 2007. Today, they have roughly 70,000 employees and serve about 125 million customers across postpaid, prepaid, and wholesale markets.
And what really changed the trajectory of this company was the Sprint merger that closed in April 2020. That deal gave T-Mobile a massive mid-band spectrum advantage, and they have used it to build what is now the largest 5G network in the country by coverage. They went from number 3 to number 1 in subscribers.
Right, and the Un-carrier revolution under John Legere and then Mike Sievert just completely rewrote the playbook for how wireless companies compete. No contracts, transparent pricing, free international roaming. They forced AT&T and Verizon to respond. Now there is a new sheriff in town.
That would be Srini Gopalan, who took over as CEO in November 2025 after running Deutsche Telekom's German operations. He doubled the growth rate there, expanded fiber aggressively, and took mobile market share to record levels. So Deutsche Telekom sent their top operator to run their most valuable asset.
And Gopalan wasted no time. At Capital Markets Day in February 2026, he laid out a multi-year growth roadmap that is much more ambitious than what the street was expecting. We will get into those numbers, but the headline is that T-Mobile is not content just being the biggest wireless carrier. They want to be the biggest broadband provider too.
Let's talk about how T-Mobile actually makes money. The core business is still wireless, which accounts for the vast majority of revenue. They earn monthly service fees from postpaid and prepaid customers, plus equipment revenue from device sales. Service revenue is the higher margin stream and is what the street focuses on.
But the growth story has shifted to broadband. T-Mobile now has 6.9 million fixed wireless access subscribers, and that number is growing about 30% year over year. Fixed wireless takes their existing 5G network and delivers home internet over it, which means they can offer broadband without laying a single cable.
Which is why the margins are so attractive. The network is already built for mobile. Fixed wireless is essentially selling excess capacity. They are also layering in fiber through joint ventures, keeping capital expenditure relatively light compared to a traditional cable company.
And at Capital Markets Day, Gopalan said they are targeting 18 to 19 million total broadband subscribers by 2030, with about 15 million on fixed wireless and 3 to 4 million on fiber. That would make T-Mobile one of the largest broadband providers in the country. That is bold.
All right, let's dig into the numbers. Starting with valuation, T-Mobile shares are trading at $197.54 as of our tape date. Market cap sits at about $221 billion. The 52-week range is $181.36 on the low end to $267.96 on the high.
So the stock is trading a lot closer to its 52-week low than its high. What does the valuation picture look like?
Trailing PE is about 20.3 times earnings, and forward PE is roughly 20.5 times. Price to book is 3.72 times, which is premium for the telecom space. EV to EBITDA comes in at 10.65 times, and the PEG ratio is around 1.8 times. So this is a growth-priced telecom.
Meaning investors are paying up relative to AT&T and Verizon because they expect faster growth.
Exactly. T-Mobile commands a premium on the expectation that revenue and earnings growth will outpace the legacy carriers. The question is whether the growth rate justifies paying roughly twice the EV to EBITDA multiple of AT&T. Moving to income and growth, trailing 12-month revenue comes in at approximately $88.3 billion, growing at about 8% year over year. If you look at the quarterly trend, it tells a strong story. Q1 2025 at $20.9 billion, Q2 at $21.1 billion, Q3 at $22 billion, and Q4 at $24.3 billion.
So revenue is accelerating through the year. That Q4 number really popped.
It did. Now, earnings per share on a trailing 12-month basis is $9.74. On an adjusted basis for Q4 alone, that was $2.41, essentially in line with estimates. EPS growth is running around 12%.
And the margins?
Gross margin is 54.8%, which is strong for a telecom. Operating margin is 21.2%, and net margin is 12.4%. The operating margin is notable because it reflects how efficiently T-Mobile converts revenue into operating profit after the Sprint integration synergies. Cash flow is where T-Mobile really shines. Free cash flow over the trailing 12 months is approximately $18 billion. MoffettNathanson highlighted an 80% year-over-year surge in free cash flow, which is remarkable for a company this size.
$18 billion in free cash flow. That is serious money. What is the yield on that?
FCF yield is about 8.1%, which is extremely attractive. That means for every dollar of market cap, T-Mobile is generating over 8 cents of free cash flow. Operating cash flow was around $26.7 billion on a trailing 12-month basis, and capital expenditure was roughly $9.5 billion.
And they are using that cash flow for buybacks too, right?
Correct. They targeted about $5 billion in share buybacks in Q1 2026 alone. Management has been aggressive about returning cash to shareholders through both buybacks and dividends. Now, the balance sheet is where it gets a little more complicated. Total debt is $122.3 billion. Net debt is $116.7 billion. That puts debt to EBITDA at about 3.7 times on a GAAP basis.
That sounds like a lot of debt.
It is significant. A big chunk of that is legacy from the Sprint acquisition and the more recent U.S. Cellular deal. Total assets are $219.2 billion, and the current ratio is right at 1.0, meaning current assets just barely cover current liabilities. Cash on hand is about $5.6 billion.
What about dividends?
T-Mobile is relatively new to the dividend game. The current yield is 1.92%, with an annual payout of $3.80 per share. The payout ratio is only about 19.5%, which gives them enormous room to grow the dividend. They have been paying dividends for about 3 years now, so there is no long streak to speak of. But the low payout ratio signals sustainability. Overall, T-Mobile's financial health is solid. The massive free cash flow generation and strong revenue growth trajectory more than compensate for the elevated debt load. The company is growing into its balance sheet rather than being weighed down by it.
Solid, strong cash flow machine with a debt bill that is manageable because the top line keeps growing. I like that framing. All right, let's see what Wall Street thinks. The consensus rating from 17 analysts is buy. The median 12-month price target is about $265, which implies roughly 34% upside from current levels.
Some notable calls. MoffettNathanson has a buy rating with a $254 target, specifically citing the 3.3 million postpaid phone net adds in 2025 and that 80% free cash flow surge. Daiwa Securities upgraded T-Mobile to outperform in February. Wells Fargo and Barclays both maintain overweight ratings.
Any bears out there?
Weiss Ratings downgraded to hold in January 2026, and Citigroup has maintained a neutral rating through multiple reviews. Bernstein also sits at market perform, so there is a cautious camp, but the majority of the street is bullish.
And what about insider activity? Because that tells you what the people who actually run the company think.
Insiders have been net sellers. In Q1 2026, total insider sales reached about $150.8 million against less than $2 million in purchases. Director Raul Clore sold 550,000 shares worth about $120 million in February. Former CEO Mike Sievert sold 80,000 shares worth about $17 million. These were planned dispositions, but the volume is notable.
Time for the bull and bear case. I will take the bull side first. The number one catalyst is fixed wireless broadband. 6.9 million subscribers growing 30% a year, targeting 15 million by 2030. This is a huge new revenue stream built on top of existing network infrastructure.
And on the bear side, the biggest concern is that debt load, $122 billion in total debt at 3.7 times EBITDA. That constrains financial flexibility, especially if interest rates stay elevated or if the company needs to spend more on spectrum or network build-out than planned.
Bull number 2, the U.S. cellular acquisition. T-Mobile picked up spectrum across 21 states, giving them a massive boost in rural America. They are targeting 20% market share near-term and 33% plus long-term. That is a whole new customer base to monetize.
Bear number 2, competitive pressure is real. Verizon is targeting 750,000 to 1 million postpaid phone net adds in 2026, which would be 2 to 3 times their recent pace. AT&T just won the Root Metrics Awards for Best Overall, Most Reliable, and Fastest Network. The competition is not standing still.
Bull number 3, 5G Advanced. T-Mobile is rolling out at least 6 new 5G Advanced features in 2026, including network slicing and RedCap IoT. And Gopalan is positioning T-Mobile as a distributed AI computing platform at the network edge. If that vision plays out, it opens up enterprise revenue streams that do not exist today.
Bear number 3, CEO transition risk. Gopalan took over in November 2025, and while his track record in Germany is impressive, he is shifting the strategy from pure subscriber growth to a higher value customer mix and convergent service bundles. That is a meaningful pivot, and execution is not guaranteed.
Bull number 4, that free cash flow, $18 billion a year and growing. That funds buybacks, dividend growth, debt paydown, and investment all at once. Very few companies generate this kind of cash relative to their market cap.
And bear number 4, macroeconomic sensitivity. If consumer spending slows, wireless upgrades and broadband attach rates could soften. The premium valuation leaves less room for error if growth disappoints.
Let's put T-Mobile next to its peers for some context. We are comparing against AT&T, Verizon, and Comcast.
On valuation, T-Mobile's P of 20.3 times is well above AT&T at roughly 14 to 15 times, Verizon at about 10 to 11 times, and Comcast at about 9 times. T-Mobile is clearly the premium-priced name in this group.
But T-Mobile is also growing faster than all of them, right?
Significantly. T-Mobile's revenue is growing at about 8% versus low single digits for the others. The EV to EBITDA at 10.65 times is roughly double AT&T's 6.3 times and more than double Comcast's 4.4 times. On the flip side, T-Mobile's dividend yield at 1.9% is the lowest of the group. AT&T yields about 4.1%, Comcast 4.5%, and Verizon roughly 6.5%.
So it is the classic growth versus income trade-off. If you want yield, you go AT&T or Verizon. If you want growth, you pay up for T-Mobile.
That is exactly right. And the free cash flow yield of 8% is actually the most compelling number in the comparison because it shows T-Mobile is generating real cash even at the premium valuation.
All right, bottom line time. T-Mobile US is a company that has completely reinvented itself over the past decade. From scrappy number 3 to the largest wireless carrier in America, and now they're going after broadband with the same aggressive playbook. The financials back it up. 8% revenue growth, $18 billion in free cash flow, and a new CEO with a track record of execution.
The one number investors should watch going forward is the fixed wireless subscriber count. That is the leading indicator of whether T-Mobile's broadband ambitions are translating into real revenue diversification. If those net adds stay above 500,000 per quarter, the growth story holds. Next earnings date is April 28th.
If you are getting value from these deep dives, make sure you subscribe to Charged Alpha wherever you get your podcasts. We are building the S&P 500 stock encyclopedia, one company at a time, and we do not want you to miss an episode. Leave us a review if you have a minute. It helps more people find the show.
We will leave you with a quote from Peter Drucker. The best way to predict the future is to create it.
And that is exactly what T-Mobile is trying to do. building the future of connectivity from the ground up. That is our deep dive on T-Mobile US, ticker TMUS, episode 102 of Charged Alpha.
70,000 employees, and they still cannot figure out why my bill goes up every year.
This is Charged Alpha, the S&P 500 stock encyclopedia. See you next time. Charged Alpha is for informational and educational purposes only. Nothing in this podcast constitutes investment advice, a recommendation to buy or sell any security, or an offer of any financial product. All data is sourced from public filings, third-party data providers, and reputable financial sources believed to be reliable, but accuracy is not guaranteed. Always do your own research and consult a qualified financial advisor before making investment decisions. Past performance does not guarantee future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.